Hey, everybody. Welcome to Swan Signal Live. I'm Sam Callahan. I'm the lead analyst at Swan Bitcoin. And we got another excellent episode for you guys lined up today. Really special guest from the traditional finance world is joining us. But before we get into it, I want to talk about Pacific Bitcoin 2024. That is the Bitcoin festival that Swan throws every year. It's one of the best times of the year. So go to this QR code. You can lock in early bird tickets. You get a full refund in February if you buy right now, and this is the cheapest prices you're going to get. So if you think you're even remotely possible that you're going to go to Pacific Bitcoin, now's the time to lock in those cheap prices. Hit this QR code right here. Go to Pacific Bitcoin's website. Check out the last time speakers. It was an excellent time. So go check it out. What we're going to be talking about today is really zooming out. We're going to talk about kind of investment philosophy. We're going to talk about portfolio construction. We're going to talk about the shifting investing regime that has occurred potentially over the last couple of years and how investors can protect their wealth. And we have the perfect guest right now. We are bringing on Bob Elliott. He's the former Bridgewater Investment Committee member, as well as the CEO and CIO of Unlimited. Thanks so much for coming on the show, Bob.
Hey, thanks for having me.
Yeah, so you've had a very long and storied career so far in the investment world, and I wanted to just talk a little bit about your background, how you got into investing, and what you're kind of doing now. Maybe kind of go back, however far back you want to go. But I would love to hear just your story.
Yeah, I mean, I got into investing out of college, and I actually didn't have much of a academic investing background. I was actually a botanist by academic training.
Botanist. Wow.
That's right, a botanist. So every once in a while, my Twitter feed, you can see, I put pictures of pumpkins and other things that I'm growing. It's still a hobby, but part of I was also interested in public health and economic development issues and things like that. And so over time, increasingly realized just basically the macroeconomy drives so much of what's going on pretty much everywhere. Mm-hmm. Whether it's, buying a car or a house or, what wages you're getting, all of those things are driven by macroeconomic forces. And so I actually came to Bridgewater with the intention of kind of getting a paid master's degree in macro and then going on my way with that background. And, over the course of several years, just increasingly fell in love with macro markets and trading and systematic investing. And so was there for almost 15 years, building Wow. and really helping build Bridgewater from being what it was, which was a challenger, a real challenger in the macro space, to being the incumbent. Left about 5 years ago, wanted to get back to something smaller and more entrepreneurial. Mm-hmm. When you're the incumbent, it's always a little bit of a challenge to keep innovating, and did a couple of different things, but sort of over time, increasingly recognized that 2 and 20 businesses, which, hedge funds, venture, private equity, things like that, those are good businesses for the manager. And I can tell you, having sat on the other side, but they're not great for the investor. And the reason why that is those businesses are often good at generating good returns, but they're also good at charging high fees. And so that got me to thinking about whether there was a way to bring those sort of concepts of diversified low-cost indexing, which have obviously totally changed stock and bond investing and how many investors invest today, if we could bring that to the world of 2 and 20. And so that's really what I've been on a mission on for the last couple of years, which is using technology to replicate the returns of 2 and 20 style strategies, and then packaging them in a way that makes them available to all investors at a much lower cost and better liquidity than typical high cost LP positions. So that's what I've been doing at Unlimited. But as part of that, I'm still highly plugged into the macro economy, to investing more broadly.
Absolutely.
So that's hopefully what we're here to talk about.
Yeah, we are. Yeah. But, at Bridgewater, if for listeners who aren't familiar, Bridgewater is the largest hedge fund in the world. And you might be familiar with his founder, Ray Dalio. He's written a lot of books, really respected because they kind of set up this framework for investing way back in, I think, the 80s, where this started to get adopted, and then it became very popular. And it's around diversification and having like a all-weather portfolio that could perform well and provide consistent returns over different investing environments. And so, Bob, you said you've been there for 15 years. I'd love to just go back and kind of talk about the investment philosophy that you kind of learned when working at Bridgewater and how you kind of apply it today?
Well, I think the biggest thing is when you're sitting as a macro investor, what I mean by macro investor is an investor who's primarily focused on the returns of country level equity indices, bond markets, currency markets, commodities, et cetera. Not individual stock picking,
Mm-hmm.
but sort of the overall index style investing. What you learn through that process is that there are sort of fundamental cause effect drivers, particularly tied to the macro economy, that drive macro asset market returns. And so I think one of the key things is really helpful in terms of my development as an investor is developing that sort of rich, deep understanding of the macro connections. So why would bond yields move up, or why would they move down, or stocks move up or stocks move down? A lot of times at the macro level, those are driven by sort of these fundamental properties of the economy, which, for instance, whether growth is getting stronger than people expect, or inflation is lower than people expect, or monetary policy is tighter or easier than people expect. Those different underlying core drivers then are reflected in what goes on in macro asset pricing. And so in a lot of ways, I think macro markets really is a really useful lens, because it allows you to connect the big themes that are going on in the economy to market returns that give opportunity for betting, or what we call generating alpha over time.
Yeah. So you said that there are these like connectors, and you brought up inflation, growth, monetary policy. Is that how you think about investing in these different asset classes? And you kind of look at their relative performance, and that's how you kind of construct a portfolio? Is kind of you start there and then move out?
Well, I think it's important to think about whenever you're investing. There's basically two sources of investment return. One is what we call beta, which is passive investing, which means if you buy stocks, stock market, you would expect over time for that to have a positive return, right? Because if it didn't, why would you ever buy stocks? Why would you ever give a company your money through
Right.
equity issuance? And so the key things to think about for beta, is what we call it, is to think about how do you balance your portfolio to most effectively be sort of balanced to different macroeconomic environments. So sometimes inflation is going to be high, sometimes it's low, sometimes growth is strong, sometimes it's weak. And how do you make sure that you don't get overweight on one particular outcome or another? The other side of generating returns is something called alpha. And what alpha is basically taking bets in markets, right? So saying, I think, the market pricing is a certain thing. For instance, if you think about the Fed right now, the market is pricing the Fed to cut 4 times in 2024. You can either think that that's too much or too little or just right. And that view relative to what's priced into the market is what generates alpha, right? If you're right, then you make money on that trade. And if you're wrong, you don't make, you lose money on that trade.
Exactly.
And so you want to think about those two things differently. For beta, it's about balance. And for alpha, it's about really understanding those macro linkages and comparing them to the market pricing to see where there are opportunities where the probabilities that are priced into the markets are inconsistent with the probabilities in the macro economy.
That makes a lot of sense. And let's just kind of go into it right now. I mean, we kind of saw, I would say, a shift in the inflation picture over the last couple of years, pretty substantial. You saw the Fed go on one of the fastest hiking cycles in its entire history. And then you have growth. Nominal growth is pretty high, I would say, in terms of like historical averages. Do you think we've kind of entered into a new investment regime for the 2020s compared to, say, the last couple decades? And how do you think investors should think about if we are into a new investing regime right now?
Yeah, well, I think most of us have in our professional experiences basically experienced two related environments. One is a wave of secular disinflationary pressure that really started in the mid 80s and played out basically until COVID, where inflation kept falling for a number of structural reasons related to the global integration of supply chains and actually increased sort of peace globally. And those two things were related. And so it basically created a tailwind for the central banks across the developed world to keep easing anytime that you saw growth weakness. And then the second piece that we saw was in the last 15 years, the 15 years basically through part of COVID, was a real challenge that central banks had re-stimulating the economy. The reason why that is because we were experiencing something that what I'd call a depression. And what I mean by that is not that everyone had lost their jobs. It just meant that we had too much debt relative to our income. And so it meant that it was hard to get people to borrow. Typically, a central bank, when they're trying to stimulate the economy, lowers interest rates. People borrow more, buy a car, all that stuff, buy a house, etc. But when you have too much debt, you can't do that. And so the way that the central bank had to respond to that was through huge monetary stimulation, right? Through printing money and handing it, buying assets, and eventually handing it to people themselves. Those sorts of dynamics are unlikely to persist in the future because we've now transitioned from a world of secular disinflation to more secular inflationary pressures, not huge, but certainly not disinflationary pressures. And we've gotten to a point where we've gotten most of the households and businesses in America out of the depression scenario, where they now have relatively good nominal incomes and they're spending that. And so we actually have pretty good growth, all things considered. And we have a pretty good economy these days, all things considered, given those steps that we're taking. And so probably what we're going to see over the next 10 years is going to look a lot different than what we saw over the last 15.
I think, when people say nominal income is pretty good for a lot of Americans, they would say, hold on. When you do that against inflation, when you look at like real wages, it kind of paints a different story. So what do you say to that? Like, why does nominal wage growth matter? And why not just always look at like real wage growth?
Well, I think it's true that we had a circumstance, and this is typical of any time you have an inflationary impulse, which is prices rise faster than wages rise.
Mm-hmm.
And so that's what we saw really for the first 2 years of this inflation period. Now we're starting to see that flip, right? Which is prices are starting to moderate, and it's taking a while for wage growth to catch up. But now wage growth is actually above price growth, which is beneficial to the consumer. And so what I'd say is, if you're looking at it from the Fed's perspective, right, what the Fed cares about, particularly when it comes to inflation is a nominal concept. So that's an important thing to consider, which is what the Fed cares about is how fast are prices rising. And so nominal wages are related to nominal spending, which is related to nominal price increases, right? And so that is the connection. So that's why so often the Fed is focused on nominal price rises, even though, of course, for the day-to-day consumer, what you really care about is like, how much is your paycheck going up relative to what does the oil price look like when you're thinking about whether your head's above water or not.
Yeah. And then, we focused a lot on the labor market, just in general. Like, the public officials say that it's really tight, that the unemployment rate is still at historic lows. And I think that surprises people because the Fed did raise interest rates all the way up to like 5.5 really fast. And we had a lot of leverage in the system. A lot of people were surprised the fact that they got this far. And we haven't seen a lot of rise in unemployment, and we haven't seen a ton of disruptions in the economy. Are you surprised that they were able to get it up this high? And what do you make of this low unemployment rate? Do you think that's subject to change soon?
Yeah, I mean, I was just the other day reviewing some stuff that I was saying back last fall, where basically, I don't know if you remember when the sort of Bloomberg consensus economists were 100% probability
That's never
of a
good.
recession, right? I don't know. Anytime you can get 100% of economists to agree to anything, you probably should fade that. And at the time, I was a bit of an outlier, and I said, no, we're not going to have a recession within 12 months. It's not going to happen. And the reason why that is, there's two main reasons why that is. First of all, I think it's important to contextualize how macro cycles work. Most of us have only experienced like 20 and 08 as downturns, and those were very acute crisis experiences. A typical macro cycle honestly takes forever. It takes literally years and years to play out. And it's like I sort of joke, people want their recessions like they want their Amazon packages, order it right now, get it, between 3 and 5 this afternoon. That's what people want. And it's just like not how it works, because it takes a while. Interest rates rise, and then you hold off lending and you hold off spending, and then it takes some time, and then eventually you have to refinance. And this is just a very slow moving process. And so the macro economy honestly moves so much slower than what people actually think. People's expectations whip around, particularly if you're on Twitter and stuff like that. Like, day to day expectations. It's a boom, it's a bust, it's a boom, it's a bust. The reality is it's moving at a glacial pace. So that's an important thing to just contextualize, that these things typically take 3 to 5 years to play out from the beginning of a meaningful tightening cycle to the bottoming. So, we're not that far into it, right? We're only 18 months into something that could take easily 5 years to play out. The second thing I'd say is the economy was basically totally restructured following the GFC, the global financial crisis, to reduce the sensitivity of households and businesses in particular on borrowing, and particularly on short end borrowing. One of the big problems with the global financial crisis was that households had borrowed a lot of floater mortgages, and those mortgages reset, and then those resets were too high relative to their incomes, and then they defaulted on their loans, and they stopped paying for their houses, and the rest is well-known history. By restructuring the debt markets, both for businesses and households, to extend maturity, right, to only 90+% of mortgages are now long duration, 20 or 30 years, it means that when the Fed raises interest rates, there's actually very little effect. Now imagine if you're a middle class household, you're getting your wages growing now at about 5% a year, and interest rates have risen from 0 to 5.5%, right? But your mortgage hasn't risen. So your wage growth has risen. The money that you're making in your bank account has risen, right? Your money market fund has risen in terms of its yield, but your borrowing costs haven't changed. And so actually, in some ways, many of those middle-class households are in some ways better off today than they were before, through that dynamic of having locked in a very low mortgage cost, very low borrowing cost for a long time. And so the result is the Fed basically has to either get interest rates to be up high for a long time, or they have to get asset prices to fall. And so far, at this point, stocks are basically at all-time highs on a total return basis, and house prices are at all-time highs. And those are the sorts of things that don't, until that changes, the economy isn't meaningfully turning.
Do you think it's almost like with the Fed raising interest rates right now, also people can just turn and pour money into a money market fund and earn a pretty decent yield now, which kind of helps their balance sheets, the household balance sheets too. It's almost like rising interest rates could actually cause more inflation at that point. Am I thinking about that right?
Yeah, I think it's a reasonable intuition. I think you have to balance the incremental income that you earn from the elevated interest rates relative to the reduced borrowing that occurs from higher interest rates. And so, and part of the thing to say is the income that you earn on your savings, your propensity to spend it, particularly those who earn significant income on their savings, their propensity to spend is relatively low. Whereas when you borrow to buy a house or buy a car, right, or washing machine, that's a pretty direct spend into the economy on economic activity. And so while you're right, those two things kind of offset each other to some extent, the impact on borrowing is definitely larger than the impact on increased income and savings for households and businesses. It's just that they mute each other to some extent. And because the duration of because people have termed out the duration, households and businesses have turned out the duration of their borrowing, the higher interest rate level isn't affecting them nearly as quickly as it did in previous cycles.
Yeah. That makes sense. I mean, they locked in these fixed 30-year mortgages. They're not going to be impacted by the rise in interest rates.
I mean, think about it. Interest rates could be 1,000%, and if you've locked in your 2% mortgage,
you're not gonna. It's not
doesn't make any difference, right?
Deductible loans that blew up in the global financial crisis. But what I did read that in the UK and in Australia, they do have a lot of adjustable mortgages there. And we live in a very globalized economy. Do you think there could be a contagion factor there where, the real estate market in Australia or the UK that are impacted by the rise in interest rates that could kind of trigger other things? Or do you think, the US real estate is just the one to watch and that's kind of drives everything? But do you ever think about that?
Yeah, of course. I think a lot of folks have pointed to these high floater rate mortgage economies and suggested that there might be a risk from those resets. And what I'd say is, first, it takes a while for those resets to play out. Like they don't reset every time, like the UK, often people lock for 5 and then it gets reset. So, there's sort of a flow of those things, but it's going to take time. And the second important thing to recognize is that while the interest rates are rising on the mortgage borrowing, even for those economies, wage growth is actually typically rising faster than the resets. And that's a pretty important thing to think about. If you look at the UK, for instance, wage growth is now running at 8% a year, but interest rates have only risen a few hundred basis points. And so actually what's happening is wage growth is outpacing the rise in interest burdens, right? In debt servicing cost. And so again, some of those households are actually better off because they're getting the 8% wage growth against a few hundred basis point rise in their financing costs.
Yeah, I mean, that makes a lot of sense. And like when I look at what you're saying with the mortgages and households too, locking in these fixed rates, you kind of say the same thing for the corporate sector as well. I mean, they basically binged on really cheap debt. And now I saw a stat that nearly half of S&P 500 debt is set to mature after 2030. And so they just have a longer runway here. But the one, part of the economy that I look at is the sovereign level, where the United States government seems to have to roll over a lot of debt sooner than these corporations, sooner than these households. And then they're going to have to face higher financing costs when they do. How do you think about the sovereign level? I mean, you look at the debt, you look at the interest expense that's exploding on that debt, and you also look at the deficits. And how do you look at that fiscal side of things and how it's going to impact your, allocations as well as your kind of framework around inflation and growth? I would love to just hear your thoughts around that.
Yeah, when it comes to the government fiscal circumstance, you want to think about deficits, and particularly the changes or expansion in deficits is supportive to economic activity, and declining deficits or increasing surpluses is net detrimental to economic activity. And so part of the reason why we've been able to have such a strong economy over the course of the last couple of years is we've transitioned from a point of running moderate deficits to running relatively sizable deficits, particularly in the context of running 5, 6, 7, 8% deficits in an environment where unemployment is at secular lows is pretty unusual. Represents pretty expansionary policy. The combination of the rise in debt and the elevated interest rates is increasing interest expense. And I think the question is, which many people have pointed to, but this topic is really one where you have to get into the nuts and bolts of the numbers. So if you just think about it very, very sort of simply, we have about 100% of GDP of debt, or debt to GDP in the government sector. Interest rates are, let's call it 5, because, bills reset immediately and long-term bonds take a while to reset. But let's just call it 5. That's about a 5% of GDP set of interest expense. That interest expense sounds relatively extreme, but it's roughly at the same level that we saw back in the 80s. And, I don't think anyone, the dollar didn't fall apart. The U.S. economy it wasn't a disaster. If anything, it was actually a pretty good time for the U.S. economy. And so you look at that and you sort of say this level of interest expense, while elevated, certainly, is not an intolerable level of interest expense. Now, look, does this mean that probably at some point we're going to have more contractionary fiscal policy than we currently have? Probably. But even at these levels, we still have a bond yield that's at 4.5% and nominal GDP growth that's well above that. And so we're actually depreciating the value of that existing debt stock over time. So we aren't really in a debt trap here. I think some folks sort of look at share of revenue and stuff like that and say, we're in it's a disaster. It's not really the case. We're back to basically 80s type scenarios, which were totally manageable. And so, I think the thing is, the real question is going to be, how stimulative are we going to be in the next downturn? Because typically you see budgets blow out in a downturn situation. And given that we've already increased our spending considerably at this point relative to the income, I think it's a real question about how expansive fiscal policy will be in the next downturn. So that might make it actually more challenging rather than less challenging in the future.
Yeah, I actually wrote about that recently, of how we're kind of running these large deficits that typically you see in a recession almost before the recession happens, and how unusual that is. Then what's going to happen if we do hit a real recession and we see unemployment spike and then the deficit blow out like a lot more, even at elevated levels right now? What would happen? What would happen to the inflation picture? But like I have to like, so the early 80s and now, I mean, the difference does seem that the debt GDP is almost triple, probably over triple what it was in the early 80s. Don't you think that constrains them a little bit, or no?
You had double-digit financing costs in the 80s too, right? So
Yeah,
the difference.
Volcker.
Yeah. So I mean, basically, like that sort of those two things net each other out when you're thinking about that sort
Okay.
of 5% interest, 5% of GDP interest expense, which to be clear is pretty high. It's not. I'm not saying it's
Mhm.
it's nothing. It's just this idea that there's a straight line between 5% of GDP interest expense and the total devaluation of the dollar relative to hard assets. Like that's not right. Like many countries have operated with interest expense at this level. What it requires is over time, either frankly, central bank printing
Yeah.
to enable those deficits to persist, like in Japan, or it requires some fiscal contraction in order to create an overall financing level that is, tolerable given the demand for the bonds. I mean, look, in the U.S., we're kind of lucky. Like people really want our bonds in a lot of ways, and so the real question is what's the clearing price, much more than whether people will demand them. Just kind of in the same way, Japan has had huge deficits for a long time, has and a lot of money printing, but like where's the inflation in Japan? It's not there, and that's because there's still a lot of demand for Japanese bonds, particularly in Japan, from the domestic savings sector and the recycling of savings into those assets.
Do you think that's where we're headed? Because Japan owns like 50% of its bond market right now. Do you think that's kind of where we could be headed in terms of the United States?
Well, I think that it's certainly possible that without meaningful improvements in either productivity or labor force growth, it's going to be challenging to pay off the existing debt stock without an undesirable fiscal contraction or or a significant, right, like tax increase that people are not gonna
Not gonna like
tolerate,
that.
right? And so the answer to that question is, well, then if you won't accept much higher, more elevated interest rates than is appropriate given the macroeconomic circumstances, and you won't tax people, then the other solution is to print money to buy the bonds. The basic question then becomes that balance between the deflationary pressures, the disinflationary pressures that we have in the economy, which are real. Like we have, a secular, quite weak set of dynamics related to population growth,
Hmm.
and so that is a disinflationary pressure, right? That is a long-term disinflationary pressure, like we've seen in Japan over the course of the last 20 or 30 years. And so the question is how much printing relative to how much disinflationary pressure exists, particularly not right now, but like there will be a downturn. That downturn will happen. It'll create disinflationary pressures. And the question is, how much does the central bank, how much does the Fed really stimulate in response to those disinflationary pressures? Like in Japan, the answer was they actually stimulated too little. And Japan saw 30 years of deflation, right? Terrible deflation in the economy. Other economies have been known to stimulate too much. And so it's really going to come down to what's that stimulative pressure from buying the bonds relative to the disinflationary pressure from the cyclical conditions and the more structural demographic challenges.
Yeah, and I think a lot of people, the Fed right now, they're doing QT, they're reducing their balance sheet, they're tightening monetary conditions, but you see a lot of investors flowing into long dated bonds. And you said that the market expects 4 rate cuts next year. Do you think like they're kind of looking through like the potential recession and already planning on the Fed cutting and them doing more stimulative things? They're the most overweight bonds investors are since the global financial crisis. And for me, it's like you're basically betting on a Fed cut. But if we are in this environment of inflation, bonds aren't necessarily going to protect you over the long term. You're going to want maybe other assets like that are scarce, real world assets in that environment to provide that safe haven. But you have all these investors flowing into bonds right now. What do you make of that? What do you make of the fact that they're the most overweight since the global financial crisis, and the Treasury bonds are set to maybe have the third consecutive year of losses for the first time in its history?
Yeah, I mean, the bond market's always interesting compared to stock market and some other markets, where in the bond market, when the price goes down, people become, demand more of the asset, which is very different from, stocks or
Mm.
other sort of considered risky assets, where the price goes down and people are typically less interested in buying the asset. So it's kind of a funny, dynamic that exists in the bond market, and that's because people, frankly, out of convention, look at those assets based on a yield rather than based upon a price, right? Same way, if you looked at stocks based upon yield, you'd think that they didn't make sense today. The yield was very low today, and when they sell off, the yield would be very high. It's just not how people think about it. And so, I think what you're seeing, I think in a lot of ways for the bond market is, like, once again, and we've seen a few patterns of this over the course of the last 18 months, investors are getting ahead of themselves, where they're positioning for the recession without recognizing the steps that it's going to take to get to recession. And what those steps are is, given that we have an economy where nominal growth is too high. Third quarter nominal GDP growth was 8%, right? Like, I mean,
Yeah.
that's way too high given the Fed's mandate. So the way we're going to slow the economy down is, first, interest rates are going to rise. Those long-term interest rates rising are then going to create a deterioration in stock prices. That deterioration in stock prices is then going to create a weakening of demand. That weakening of demand will then kick off lower earnings. Lower earnings will lead to lower employment, lower wages, less nominal spending, and finally inflation fully cools in the economy on a structural basis. Could tactically change based upon supply issues, but I'm talking about on a more structural basis, the way the Fed
Mhm.
looks at it. And so that's the order of operations. But you don't buy bonds today, because you have to go through the process of, first, the bond yields have to rise in order to slow the economy,
Mhm.
right? So step one, bond yields rise. Step two, the economy slows down. And I think people are just getting ahead of themselves. And to be clear, they've done this like 5 times in the last 18 months, where a bunch of cuts get priced into the 2-year, into the short rate market. And then the economy is mostly fine. And then those cuts come out and bond yields rise. And it's just like over and over and over again. And I think it's because, just going back to that more secular story, people are very used to the type of macro environment that most of their careers have been in, which is when the Fed has been
Yeah.
super responsive to negative growth shocks, right? Because there was no inflation problem. But today there is an inflation problem, and their reaction function is just totally different than what people have seen in their careers.
It's almost like a Pavlovian response. This is where we go. This is what we're used to. We're going to go into long dated bonds. It's I guess it's difficult for me to kind of conceptualize, because if what you say is true and yields are going to go up, it's just going to worsen the fiscal picture again. I know I have to go back to that, because like it increases that interest expense even higher. And then that causes more inflationary pressures. But then if the asset prices fall because the bond yields are going up, that's going to reduce tax receipts, because we have this financialized economy, and so that just worsens the fiscal picture even more. And so, how can people not expect them to go in? Because, like you said, they can either choose to reduce their spending, tighten the belts, or they can go in and provide more, stimulus, as you put it. And it just seems to me like that's the likely scenario. And so investors are going to want to maybe prepare for that. And again, like, long dated bonds in that environment, I mean, it's going to be not exactly where you'd want to be, in my opinion. Like, how do you kind of?
Well, I think there's a through time story here, which is that bond yields rising, which would then kick off the necessary slowing of the economy, would
Mhm.
then sow the seeds of bond yields then falling, right? And
Got
so
it.
I think that's the dynamic that plays out through time. That
Hmm.
dynamic doesn't look, in the sort of medium term, doesn't look great for bonds, because you have to have that rise before before you have the slowing of the economy. But in some ways, the real asset that looks bad and through that scenario is stocks, because right now stocks, like, just think about this on a longer term basis. Like, long-term bonds, the price of long-term bonds is down 50 to 60%, depending on how you measure it.
Yeah.
Stocks are at all-time highs, right? So one of those two assets is reflecting the increased tightening of monetary conditions in the economy, and one of those assets is not pricing an increased tightening in monetary conditions. Like, some people say, oh, well, the stock market's running at, a bit elevated PEs relative to the last 10, 15, 20 years, and failing to acknowledge the fact that real interest rates, right, have gone up 300 basis points. Like, the PE today should be reflective, the yield today on stocks, which is the inverse of the PE, should be reflective of the fact that overall interest rates have risen in the economy. But instead, the yield hasn't changed, and risk-free interest rates in the economy have risen considerably. And so I think what you're probably going to have is that pain is probably going to be felt more in the stock market when the cycle eventually turns than it is felt in the bond market.
Yeah, I seen that chart where it's like the jaws, where it's looking at the stock market and the bond market, and you're like,
Right,
something's
totally
gotta
different.
change here.
Right, and remember, I mean, this is like, finance 101. Like, bonds are in the stocks, and the reason why that is because if you think about a stock, all a stock is earnings discounted by discount rates, and bonds and discount rates are risk-free interest rates. And so, if what you have, just in a very simple model, is that your earnings are relatively, they're growing at whatever rate they're growing at, but discount rates go, real interest rates, real discount rates have gone from negative 100 basis points to positive 200 basis points. That's a huge impact on the present value of those future earnings cash flows that basically hasn't been reflected at all in the equity market in the cycle.
So you think that that's going to change, right? You think that stocks would fall if the discount rate continues to rise. I think about portfolio construction, because it's that 60-40 portfolio. It's this relationship between bonds and stocks that have existed over the last few decades, where they kind of move inversely to one another, and that kind of helps balance things. But I just read a report from AQR Capital Management looking at periods where that relationship changes, where bonds and stock prices start moving together. And what they found was rising inflation is when that happens. They talk about, how inflation reduces the values of the bond's fixed nominal cash flows. And then although stocks, you have a claim on real cash flows, that rising inflation has been associated historically with falling stock prices as well. So you don't have that protection. Like, you don't have that shock absorber that bonds once had in that environment of rising inflation. And so how does this change things for you if we are entering this period when you're thinking about diversification? If this bond stock relationship has changed, how do you provide that, like, risk adjusted return in a portfolio?
Yeah, I mean, I think a lot of people hold what's called the 60-40 portfolio. It's 60% stocks, 40% bonds. The reason why they hold that is for the points that you just highlighted, which is that, particularly if you look at the last couple of decades, bonds have been a good diversifier to stocks. When stocks go down, bonds have typically rallied, and vice versa. And so by holding both of them, because you'd expect both of them to go up over time, and they're sort of negatively related to each other, that helps reduce the volatility in your portfolio. But as you highlight, that isn't always the case. There are times when inflation is a more dominant effect. There are also times when other dynamics, for instance, geopolitical concerns, are a more dominant effect in your portfolio. And so one of the things I like to say is, the 60-40 portfolio is all in on disinflationary, strong growth, and peace. And when you look at that set of things, right, what have we had over the last 20 or 30, over the last 30 or 40 years? We've had disinflationary, strong growth, and peace. It's been a great time, right, to hold 60-40. But I wouldn't necessarily assume that those things are going to play out into the future, right? I mean, I certainly think there's good reasons to raise concern that the level of peace that we've seen over most of our lifetimes may not be the case in the future. And similarly, this sort of disinflationary dynamic that we've seen may not play out, is likely shifting towards a more inflationary structural dynamic. And the high growth that we've seen from high labor force growth and strong productivity may also not play out in the future. And so if you look at that, you got to start to look for assets that do better in those other environments, which are assets like TIPS, gold, and diversified commodities.
Yeah, I remember you shared a chart that said that 71% of financial advisors have little to no exposure to gold. And I also saw a chart from the Bank of America recently that compared the prices of real assets versus financial assets and how they're basically at historic lows. I don't know if you saw that one. And so what do you make of that? It seems like to me, it just screams like a contrarian bet that there's some kind of mispricing there. That could be opportunity for investors, especially in this new environment that you just mentioned.
Yeah, well, I think we can talk about gold, which I think is
let's talk about gold. Yeah,
let's talk about gold. I think most people, you start talking about gold and they think that you're like a crazy person, who wants to lock themselves in a small cabin in the woods with your guns and your water and, right, bury the gold in the backyard. Like, gold is a financial asset that's existed for thousands of years. The return properties of it are relatively well known. And yet sort of no one looks at it. And it's surprising because if you look at the empirical evidence, here's a very simple fact, empirical fact, which is during 12-month periods where stocks are down, gold outperforms bonds 60% of the time.
Wow.
Think about that. Gold outperforms bonds during stock drawdowns 60% of the time. And that's not just, back in the 70s, that if you did that same thing from 2000, if you did the same thing from, over the last 5 years, all of, a bunch of different time frames, a bunch of different periods. And the reason why that is that when those stock drawdowns happen and they're a function either of inflationary concerns or geopolitical concerns, often what you'll see is that gold does better than bonds in that circumstance. And so I think you say this and advisors advisors and allocators, they sort of look at you like, oh, why would you ever bring that up? And I'm like, look, whether you believe like gold, is one thing or another, or you think I'm a crazy person, just like look at the empirical evidence. If I told you there was an asset that was a better diversifier 60% of the time, like zero would not be your opening bid for the allocation to that asset, right? Yet that is essentially the bid by 95% of investors, is to hold essentially zero gold.
Yeah, it's shocking to me. I mean, if you're looking for risk-adjusted returns, and if what you said is true in terms of drawdowns and gold performs 60% of the time better than bonds, I mean, how are people so under allocated to this thing? It's wild to me. When you look at gold,
I think the key issue that I think people have is when they think about financial assets, they think about yielding financial assets.
Right. They want that.
I probably don't have to talk to you about this, but I think that's a real thing, which is they say, well, if it doesn't have yield, it doesn't have value. And no, that's not right. Just because it doesn't have yield doesn't mean it doesn't have value. In particular, gold, the way you think about gold is it's just non-interest bearing money, right? It's a type of money that's non-interest bearing, for which it's not a claim on any particular individual or institution, right? I don't want to say it can't be inflated away, because of course there's some gold supply that comes into the market over time, but the supply is relatively constrained relative to the total above ground stock of it. And so it's basically a non-interest bearing money with a highly constrained, let's say, supply element to it at any point in time. And so that I think that just investors and advisors have a hard time recognizing that an asset without yield can have value, but it can, right? It can have value based upon how it trades as a contra currency for investors.
Yeah, it doesn't have yield because there's no counterparty risk, right? That's
because there's
that's
right.
There's no counterparty risk. And then the gold, I think about what you said in terms of, why investors, they're so, obsessed with this yield that they don't kind of think about these other risks, and they don't think about the cross asset correlations of how it kind of fit into a portfolio. It has a different value proposition. And I was wondering, when you think about gold allocations, do you think about like counterparty risk at all? Like when you saw these bank failures happen in the spring, is that a reason why you want to allocate to gold? And when you do have exposure, do you buy actual spot gold, or do you do like the gold ETF or things like
Yeah.
that?
Yeah. Well, I think often folks, and this is probably where I veer away from the like guy talking gold like on the radio,
Hmm. Hmm.
uh, in Saturday afternoons. Like look, gold is a financial asset. As I said, it's a return property. It's relatively clear. If we're in a circumstance where you're really needing to hoard physical gold, like I don't know, you got
Not a good
bigger
world.
fish to fry in my sense, in my view. So I mean, I hold it through ETF
Yeah,
structures, which are
gotcha.
fine. IAU, GLD, they're liquid, they're reasonably priced. They're as efficient as it comes. But there are I'd say for those who are a little more risk averse, there are other options that are out there. Whether it's personal physical gold, which has some limitations because you got to physically protect it and you could lose it and stuff like that. But there are other options like the Perth Mint and other and Swiss savings vehicles that will hold the tagged physical gold in vaults in various jurisdictions that if you really wanted to protect yourself, you'd probably want to hold those in a diverse set of jurisdictions, hold the physical gold tagged in a diverse set of jurisdictions in the event of more significant concern. You get pretty good diversification in Australia and Switzerland and Canada and
Yeah.
stuff like that. But now we're going down the rabbit hole.
Yeah, no, we're not in the rabbit hole. You mentioned a great point. Like the yield thing is such a holdup for people, and they can understand why gold would have value because of its monetary properties, right? It's
Right.
like you brought up kind of its scarcity, its resistance to inflation. Are you surprised though? Like, because the Fed has raised rates, and that's kind of a relationship, right? So since gold doesn't offer a yield, it usually performs better in like when real yields are lower.
Right.
And when they're higher, that's been a relationship over time that's pretty well known. But it seems like gold has kind of held up in this environment. It's kind of like bouncing on the door of 2000. Are you surprised that it's performed well as the Fed has jacked interest rates up?
Yeah, as you say, the best way to think about gold is non-interest bearing money, and so when interest bearing money goes up, yields go up. You'd expect gold to underperform. I think the challenge with gold and why people often don't really fully understand its price action is it's also a tail risk hedge, both to inflation, but also tail risk of inflation, either very high inflation or very low inflation. It's also a geopolitical tail risk hedge, and so if you look at the drivers of the market over the course of the last, say, 2 years, which is when we've had that period of meaningful interest rate rises, it's coincided with a substantial increase in demand from central banks
Yeah.
who recognize the challenges, the geopolitical challenges with holding fiat money, and in particular holding bonds of Western countries using Western broker custodians, and so the fact that those can be seized or frozen and things like that. And so what you're seeing now, basically, frankly, it's two of the biggest suppliers in the world, typically, which are the Russians and the Chinese, basically taking all the gold and putting it into their central bank, and then also even going beyond that and going out and buying more physical gold that's getting imported into those economies, physical monetary gold. And so, I think that's an important factor, and it really does speak to the fact that that is a geopolitical, like the geopolitical risk. You can view geopolitical risk in a bunch of different ways. I can view, Westerners can view it vis-a-vis the Russians and the Chinese, but also the Russians and the Chinese can view geopolitical risk vis-a-vis Westerners, right? Those are
Mhm.
two different things. And so both will seek to find, non-interest bearing money that has, that is not a claim on a foreign power in times where they're concerned about geopolitical stress. And that's basically what we've been seeing. I think the thing that's actually pretty amazing is the gold rally has happened and there's been no retail participation. Retail
Mhm.
has been selling through this gold rally. So imagine a world where you get interest rates are falling, the dollar is falling, and you get some retail participation. I think it creates a really interesting mix of supportive dynamics for gold, you know, over a 3 to 5 year time frame.
I mean, I agree. I agree. You know, and I have to go to Bitcoin a little bit here because, you know, my personal view is that it has very similar value proposition of Bitcoin, everything that you just mentioned, except it kind of improves on some of gold shortcomings, like its portability, its divisibility, its auditability. I know exactly how much Bitcoin supply there's going to be today, 7 years from now, 70 years from now. Whereas gold, you don't really know how much supply is here today. You can estimate it, as well as, like you said earlier, the supply of gold fluctuates with increased demand as they increase production, whereas Bitcoin's supply is fixed. You're not going to, it doesn't fluctuate with any increase in demand. And so I think it's a very attractive value proposition. It's similar to gold. It kind of has this other growth profile of a tech stock because it's a young, very young gold. And so I would love to just hear your thoughts. Like, you know, how much have you looked into Bitcoin? How much research have you done? What's maybe some things that are holding you back from allocating to Bitcoin? Just like, I would love to just hear your thoughts.
Yeah, well, a little bit of a tale is, you know, my job at Bridgewater. One of my jobs was to run the foreign exchange book, and so about 10 years ago, I looked at, you know, it was basically like, let's go look at Bitcoin and see, you know, do you think about it like a currency, basically, right?
Mm-hmm, mm-hmm.
And you know, at the time I looked at it, and obviously 10 years ago it was pretty different.
It's tiny. Yeah,
Yeah, it was tiny.
still is.
You know, I don't know, it was trading in the hundreds, I think, at the time when I looked at it. And I basically, you know, I looked at the price action, I looked at the drivers of it, and I said, look, doesn't look like a macro driven asset. Like I talked about at the beginning, you know, part of different investors have different edges. Understanding the macro economy and how it connects to macro assets is the edge that I developed over time. And so I looked at it and said, doesn't, you know, not consistent with my edge. Might be good asset, might be a bad asset. I don't know, but I don't have any edge in trading this asset. So
Got it.
starting 10 years ago. And what I'd say is, you know, my view on it as a macro asset continues to be, you know, largely the same today. What I'd say is that it's probably, from my perspective, and now this is going to be a tradfi perspective
Yeah, no,
that may or
love
may
to hear it.
not make the crowds happy.
It's a safe space.
It's you know, I think in a lot of ways it looks like a growth venture type asset, which is that you know, it's a one Bitcoin person that I talk to regularly on Twitter about macro and other stuff. He said the thing is the technology, right? That's what he said. He said the thing is the thing about Bitcoin is the technology, and I think that was actually really insightful because what it highlighted is there's a lot of folks who want to make a macro investment case for it, particularly to try and connect with, you know, traditional investors.
Mm-hmm.
And when you look at that empirically, it just doesn't quite meet the hurdle, either in time, because it just hasn't been around that long, or in sort of day-to-day evidence of certain claims around its macro properties. But it does absolutely make the case of being a innovative technology with a set of, you know, properties and use cases that you know, may be meaningful in the future, are somewhat meaningful today, but maybe even more meaningful in the future. And so in some ways, I think about it much more like a growth venture stage investment, where buying Bitcoin is essentially like buying, you know, like a small share of, you know, it's like buying a small share of the overall system. Like
Yeah,
Lynn
like
Alden
a
said the other
piece
day,
of the
buying
internet.
Bitcoin is as if you could buy like a share of the internet back in, you know, the 90s or something like that. It's like
Correct.
it's the same concept, which I think is compelling. And so when I think about the asset and I think about what role it has in the portfolio, it has the role that like a large, you know, large venture, a growth style investment should have, which is, you know, it should, those things have, those investments have a role in a portfolio, but you also have to be prudent. Like you certainly would not want to put 100% of your capital into, you know, Carvana or Instacart or, you know, DoorDash or, you know, like all those. You wouldn't want to put 100% of your assets into
Yeah.
it because it might be successful and it might not be successful.
Yeah, I mean, I've like I've said that Bitcoin has the characteristics of gold, but the profile of like a venture bet. I mean, it's very true to look at it that way. And Bitcoin is a technology. I wonder, you said that. Would you like to just see more data? Like, is that one of the things that kind of holds you back? Like, we only have about 14, 15 years of how this thing's traded. Do you want to see how it performs in like different investing environments before you maybe get any more conviction with it as a macro asset? And then the other thing I want
Yeah.
to ask is like the correlations. Like, wouldn't an uncorrelated asset not respond the same way to certain like drivers? I would say like it would kind of move differently. Isn't that kind of what you would expect to see with an uncorrelated asset?
Yeah. So I guess these two things connect to each other. I think the question is whether thinking about it as a macro asset, right? What you want to be able to start to connect is you want to connect macroeconomic outcomes to return properties of the asset. And so my sort of like view on it as a macro asset, particularly I should say as a contra currency asset, is I would want to see more clarity between the performance, certain issues related to when you would expect contra currencies to perform well. Let's say
Mhm.
when geopolitical tensions rise, or when interest rates fall, right? Because it's a non-interest bearing money. Like I'd want to see more of a relationship between those macro properties and it serving as a contra currency, right? And instead, what it looks like, and look, I'm not just like dismissing this at hand. Like
No, I
I'm
understand.
looking at the market action. I'm thinking about this. The funny thing is like, I'm rooting for how many uncorrelated or lowly correlated assets are there out in the world? Heck,
Not
if
many.
Bitcoin could be one of those assets, that would be great, right? Like I'm not,
Yeah, I know.
so it's not like I have some like personal thing against it. I'm just looking at the empirical evidence, and I don't see that connection that's tight enough. And instead, what I see is, as you say, it's lowly correlated to macro assets, but in the same way that something like a venture growth asset is lowly correlated. Whether Square is successful or not is not really a macro dynamic, or whether is it Instacart or DoorDash or Uber Eats or this or that, right? From a technology standpoint, isn't really a macro dynamic; it's a micro dynamic. And so what I see is that the Bitcoin, at least, is trading on these micro dynamics. Is there an ETF? Is there not an ETF? Someone issues a new coin backed by Bitcoin, or a new whatever stable coin backed by Bitcoin, or this or that. It's all sort of in the micro, which means that if its macro properties are, let's say, 10 or 20% of its drivers are macro properties, and the rest, 80%, is idiosyncratic, then what you observe in terms of its price is something that looks idiosyncratic relative to the macro dynamics that are going on. So I think that's where it is right now. It, time will tell whether it's a successful technology. And betting on technologies, deserve, as I said, some part of your portfolio, but not. But certainly, you wouldn't want to go all in on that portfolio if you're thinking about creating something that's diverse.
Yeah, and like that's there's a lot of research out there looking at position sizing. Basically, is so important with an asset like Bitcoin. Um, Specifically like the volatility of it. Like we have the Nakamoto portfolio, which is interesting because we've looked at how Bitcoin can improve risk adjusted returns in a lot of different portfolios, and it kind of shows that like 1%, 2%, 5% can improve the risk adjusted returns of these portfolios. So maybe you could check that out. I don't, I think maybe
Yeah,
just some
yeah.
more time is
One of the
needed. I
one of the
understand that.
yeah, I mean, one of the challenges with that is um, the return component is the real question, right? The correlation part of it is is more clear in the terms of like how much of it looks um, idiosyncratic relative to a macro driver, and so its portfolio characteristics from a correlation standpoint are relatively clear. The real question is it going to be a successful technology, right? That's the real question, and
Yeah.
so I mean, this goes without saying. If the return of Bitcoin was negative over the last 5 years, then it would not have been a good backward-looking portfolio asset to include, right?
Right.
Um,
Which it
you
has
know,
to, yeah. Which, the success of Bitcoin kind of relies on its security as well as maintaining its scarcity, the 21 million, which is kind of baked into the security and the decentralization. And so it takes kind of an understanding of how the technology functions to better understand how the probabilities of it being successful into the future. I think it's,
yeah, and I
yeah,
think as a person who studied a lot of alt monies in my career, more so than probably most traditional finance folks, alt monies, some are successful, some emerge, many fail. And so you just have to recognize that there's a range of outcomes there.
yeah,
And to be
I,
clear, if there's a 1% probability, there's a 1% probability that Bitcoin is the primary way in which we engage in international monetary transactions 20 years from now. Well, like that's a pretty good option value to have, right? So, right.
that's
In the same way, if you looked at Uber and you said, what's the probability that I'll never take a cab again, and the entire taxi industry will be totally revamped by it, right? So it's not to say that these are bad option value, that it's a bad option value bet. It's just that the characteristics of it are not consistent with a macro asset. The characteristic asset class, maybe is the better way of saying it. It's not a macro asset class, at least at this point. It may be once it gets more widely adopted, et cetera,
yeah.
and matures, but it's not yet. But it could very well be a good bet. That part of it, I'm from my perspective, I'd say I'm humble enough to know that I'm not sure, and that is not expressing opinion, positive or negative, and I'm not humble enough to not know whether 36,000 is the right number, or 15 or 60, right, is the right number in terms of valuing that option.
Yeah, no, it's we say like probably get off zero is probably the right move. That's probably the one allocation that's incorrect right now because of the option that you mentioned. Even Hal Finney was like the second person really to start transacting in Bitcoin. And he just has a famous quote back then. He's like, "Yeah, you might want to get some just in case this this works out."
Right. That's the option value.
Like,
that's right.
Just in case.
Right. And in the same way, you might invest in 100, or 20 venture-backed, technology opportunities, right? Because one of them may be the next, Uber, et cetera, right?
I think once you understand Bitcoin's network effects and some of the things that make it scarce, you start to understand like its uniqueness and maybe how the odds of it winning. If it doesn't win, I just don't see anything else winning in terms of a decentralized money. I feel like it's a 0 to 1 event that can only happen one time, and it might fail. Like like you said, there's risks here. There's probabilities that you have to think about. Critical bugs, and it's just software when it comes down to it. But I think when you start to learn that stuff, you're like, okay, this might be the one. The one thing that I think we talk about in Bitcoin a lot, you bring up idiosyncratic drivers versus the macro drivers. And right now, Bitcoin is growing, and you're going to see that idiosyncratic moves based on short-term, like the ETF, like whether that'll happen, and like these more speculative reasons for buying Bitcoin. But then you see this like investor base growing with each cycle that actually views this as a store of value, as a digital gold, and you see that kind of grow over time. And you can kind of see it in the open network of the holding behavior of the Bitcoin holders, because it's all open source and transparent. And you see that like investor base growing in terms of viewing this thing as a macro asset. And as education grows around it, I think you're going to see that grow. And this is just my personal opinion. You're going to see that grow in terms of a driver of Bitcoin's price, and the idiosyncratic reasons drop over time if Bitcoin continues to grow and continues to be successful with its adoption. But I think you're right to say that. I mean, you're not wrong to say that there are idiosyncratic factors right now that are driving Bitcoin. There's speculators who come into Bitcoin as the price moves. They're not buying this as a macro asset. But I think people like me and others do view it as a macro asset. And I think that that's going to continue to grow as debasement continues and things like that. And so I think it's just the one thing that I wanted to just end with was, you work in ETFs. You you turned your focus to them. You said you use technology now and in the ETF space with Unlimited. I love to hear of what you're building now over there, why you decided to turn to the ETF, and maybe we can get into like how you think a spot Bitcoin ETF might change things there, or if you think it does change things. I would love to just hear your thoughts on Unlimited ETFs and maybe the spot Bitcoin ETF.
Yeah. I mean, I won't belabor exactly what we're doing at Unlimited too much, other than to say, basically, we've built technology that allows us to replicate how hedge fund managers are positioned, in close to real time, and then we take that understanding, translate it into long and short positions in liquid securities, which back an ETF. So basically, the idea, and because ETFs are available to everyone, and because we're using technology, we can offer it at a much lower cost and for everyone in the ETF wrapper. And so that's the gist of what we're doing. I think the ETF question is a particularly interesting one, because I came from a traditional sort of LP limited partnership structure experience, and I was looking around for what is the best product for the investor, and unambiguously, ETFs are the best structure for the investor. And the reason why that is because they're essentially a tax loophole. They're
Really?
liquid, they're transparent, and essentially a tax loophole, because what it allows you to do is it allows you, under the hood of the ETF, from the investor's perspective, you buy an ETF, right? It's got a ticker. It looks like a stock. If you hold it for more than a year, typically you only pay capital gains tax at the time of sale. But under the hood in the ETF, there could be all sorts of different transactions. And what the ETF allows you to do is to essentially wash what would otherwise be short-term and long-term taxable gains, using something called custom create redeems, which basically allows the operator of the ETF to reset the cost basis of the underlying securities in the product. And what that means is that you can rebalance between assets. Like if you rebalance between stocks and bonds in your personal account, and you still sell stocks when they've had a gain, then you have a taxable event.
Tax consequences. Yeah.
Right. You have tax consequences. The beautiful thing about an ETF is you can essentially do that in the ETF wrapper without any tax consequences. So maintain the
On the
value
back
of
end. So that's kind of what
That's right.
Got it. Okay.
That's right. And so, I mean, look, ETF nerds,
No, I love
we could do
No,
totally
dude,
another podcast on the nerdy aspects of the ETF. But the basic point is that it's a tax loophole, and it's a better structure for the investor because you have the ability to sell the asset on the secondary market whenever you want, right?
Very liquid.
It's totally liquid, intraday liquid. These markets, particularly now, like over the last 5 or 10 years, they've really deepened. Like NASDAQ, a huge, or NYSE, like something like a third of their income, a third of the business of NYSE is in ETFs. So they have huge commitments to make sure these products are sold and transacted super efficiently. And they've done a lot of work to do that. And in addition, actually, in the ETF wrapper, there was a bunch of regulatory changes that occurred right around COVID. So people kind of didn't even pay attention to them, which actually now allows you to run pretty sophisticated strategies in the ETF wrapper, as long as you maintain what I'd call institutional quality risk controls, which you should have anyway if you're running an active strategy. And so actually, I think what we're going to see is we're going to see a lot more active managers like ourselves bringing sophisticated investment strategies in that ETF wrapper. And the great thing about it is everyone can buy it, right? And you can buy it. You can go buy an ETF with $10, right? That's the incredible thing about it. You can have $10 or $10 million, and you both have equal access to the same.
You don't have to be an accredited investor.
You don't have to be an accredited investor. You don't have to, you don't have to have a huge account. You can go on Robinhood and buy these things, or public.com or whatever. You can go and buy them, on your phone at whatever size is appropriate for you, which I think is great. It's totally talk about democratizing, financial assets like that. That is an incredible democratization.
So it helps you guys because you can implement these strategies in the wrapper in a tax efficient way, is what I'm understanding. And then it helps the user or the clients because it improves accessibility to allow them to get access to these strategies that typically they wouldn't have access to.
That's right. And I also think the other thing I'd emphasize too is the transparency benefit, which is when you run an ETF, if you want to know what's in our ETF, or any ETF, you just go to the page, and it tells you exactly what was in it the day before, right? There's no, you invest in an LP, like a limited partnership, a fund, even a mutual fund. You literally have literally no idea what's going on, right? Like maybe they'll send you a statement, maybe you'll get transparency every half year, all sorts of things like that. With an ETF, it's great. If you have questions, if you want to understand what's going on in the product, just go look at the holdings. It's a beautiful thing for the everyday investor to gain confidence that what they're investing in is what they believe that they're investing in, right? That's the beautiful thing about the ETF structure, is it really is, in a lot of ways, the best structure for the investor, for the everyday investor, and also the best structure for the manager to operate in. Which is
I didn't know that. I didn't know about the tax efficiencies.
It's just a tax loophole.
Yeah, it's tax loophole. I didn't know that. That's really interesting, and it makes a lot of sense what you guys are doing at Unlimited. Then, I mean, from both standpoints, it seems like a win-win situation.
Absolutely.
I have to ask you, because you do focus on it, like the spot Bitcoin ETF. Not that you don't have to talk about the odds of it happening. Just like let's assume it happens. Just like kind of gold got an ETF. Like, what do you think would be some of the benefits of that, for investors that maybe it doesn't exist right now in the Bitcoin market? If there is a Bitcoin ETF out there, what are some of the benefits that you see that coming to investors or Bitcoin? Or like, do you think it's a big deal, as a lot of people are making it out to be?
Well, I think there's a combination of things. One, the accessibility of Bitcoin for let's call it a more traditional investor who is investing through a traditional investment platform, their sort of old school brokerage account. The accessibility is not that great, right? I mean, I guess a lot of these places will block even buying the Bitcoin Trust, whatever, GTBC.
Yeah, GBTC. Yeah,
GBTC. I always say that wrong. And so that, like, they'll block it because it's not like technically an ETF or technically a publicly traded, a liquid publicly traded security. And so, I think by creating the ETF, particularly, I should say ones that are institutionally backed, like these big names actually issuing these ETFs, odds are you'll get them on these platforms approved and accessible for the everyday investor, using traditional brokerages to invest in those products. The other thing I'd say is I imagine it will meaningfully bring down costs, right? Because right now, what's the fees on GBTC? Like
2%. Very,
2%.
very high.
I mean,
very high.
That's ridiculous.
Yeah, it's ridiculous. It's absurd. It's absurd.
That is ridiculous.
Basically, like putting a Bitcoin in a trust and just having it sit there. Like, it's a lot of work, right?
And so, I mean, the proliferation of these products, there's probably a lot more products filed than would ever plausibly get launched. But you have the benefit of, let's say you have 5 or 10 of these things, in the same way we've seen, in the gold market, the subsequent gold ETF launches have been cheaper than the initial GLD one, or I don't know, like EM versus the Vanguard ones. I mean, hopefully someday, Vanguard will offer a Bitcoin ETF, a spot Bitcoin ETF, and it'll cost 5 basis points, and that'll be really good for consumers, right? I mean, like there are many things in this world that are uncertain. The returns of assets, the ability to generate alpha, those things are uncertain.
Mm-hmm.
Fees are certain, right?
Yeah,
and so if you can lower the fees, you're, no matter what, in a better position than if you didn't lower the fees, right? Mm-hmm. like that is certain, right? Lower fees are better for the investor no matter what. And so I think that's going to be really good for a lot of investors.
Yeah. And I would say the lowest fees is to just take self-custody, where you have 0 fees. So
I know, but
no counterparty risk. I had to say
it. I'm not surprised you said it, but it's not necessarily as obvious as it is. As it is. I remember, as I said, 10 years ago, trying to buy Bitcoin. It was like, where exactly does one go?
Exactly. No, yeah.
It's a little easier now.
No, it's it's something the industry has to really focus on, though, is how to build it in a way that makes things easier, how to build products that improves the UX and UI for people to come in and feel a little bit, it's easier for them, right? And so that's
Right.
on us as an industry to do that. But
And the safety, I mean,
and the safety, yep,
obviously, part of
yep,
the reason why you'd buy it through a big institutional manager is because, if something happened, they're spending a lot of time making sure that that the coins get custodied in a good way, in a relative, in a safe way. But in the event that something happened, right? And we actually saw this in the financial crisis when there were certain assets that, let's say, didn't, defaulted in ways that were totally unexpected. The institutions typically make the investors whole in those circumstances. And so I think that is a layer of protection that would exist through, an ETF type structure
certainly.
issued by a big financial institution, that you would likely take that sort of, I don't know what you call it, hack risk close to zero, in a way that, if you're
You'd
custodying
be
yourself.
trusting them, and but there would maybe be some safeguards, and that's what we say. We say, like, personal responsibility. That's kind of the cost of having self sovereignty over
Right.
your wealth, and you got to trust yourself. You got to make sure that you know what you're doing, and have your security right. And the trade off is that you actually own it, and so personal responsibility. That's kind of the thing, but. I think you're exactly right. The ETF, the accessibility, it'll create lower fees compared to these other products on the market that are just killing people with fees. And I just agree with everything you
2%
said.
is crazy. It is
I
just
didn't,
it is just
I know.
crazy
I know. It's not like they're like
for
moving
not
like
doing for
gold
not
or
doing
something.
anything.
They're not. It's digital, so they just they're just moving it over.
Every time I see those, they have ads like all over the Oculus in New York,
Oh yeah, I saw it in
and
the airport in DC.
I'm like, the fees are too high.
Yeah.
Like, if your asset is being advertised in like high traffic areas of, public transit, your fees are too high. Right? You either
Absolutely.
have too much venture money or your fees are too high. All right.
Yeah,
And
they make
that's what's going on
2%
here.
on I think it's like 640,000 Bitcoin in that trust. They make 2% a year. So
Yep.
it's been a cash cow for them. But I think it's going to change when these ETFs come.
Yeah, for sure.
Hopefully they get converted. They're going to need their AUM to get jacked up if they want to keep
Right.
their
That's
profit
right. To
margins
keep
going.
those
Yeah.
margins going.
Yeah. But thank you so much, Bob. I mean, you've been very gracious with your time, and really appreciate your thoughts. Your wealth of knowledge on Twitter. So why don't you tell people where they can follow you, or what you guys are doing at Unlimited before we get
Yeah,
going?
yeah. If you found this taste of macro perspective at all interesting, definitely check me out on Twitter at Bobby Unlimited. Very active there. And if you want to learn more about what we're doing at Unlimited, definitely check out unlimitedfunds.com.
Yeah, cool. And Bob, let us know if you start to see things in the data that show Bitcoin's more of a macro driver. Make sure
I will.
you let
I
us
will.
know. Okay. Yeah. Maybe I turned your a little bit. But thanks for coming on the show. Really appreciate you taking the time. You have a wonderful Thanksgiving with you and the family. Okay.
You too. Thank you so much for having me.
All right. Thanks, Bob.
All right. Bye.
Well, I thought that was a great show. It's always interesting to hear different perspectives on Bitcoin, to kind of learn where people are kind of seeing this thing, especially with Bob. He has a lot of experience managing money. I thought it was really interesting what they're building over at Unlimited. I didn't know about some of those nuances of an ETF as like a technology that's superior for the managers themselves. So if you liked it, go follow Bob. Thanks so much for coming on the show. If you like this show, like it, comment, subscribe. Thank you so much for listening to Swan Signal. Next week, we got a interview with a CEO of a very large mining company. And so it's one of my favorite interviews that I've done in a long time. It was in person, so it's a little bit different. So I'm really excited to show you guys that next week. And I hope everybody listening has a wonderful holidays. Go spend time with family, go eat some turkey. And before we go, make sure you check out Pacific Bitcoin. This is the chance to lock in those early bird tickets. You can get a full refund in February. Come hang out with us. I'm going to be there. A lot of Swans will be there. A lot of Bitcoiners will be there. So it's always fun to get in real life interactions with other Bitcoiners, and just make sure you stack sats and have a good time. So pacificbitcoin.com, you lock in those early bird tickets, click that QR code, and thank you so much for listening. I'll see you guys next week.